Welcome, everyone, and thank you for joining us for today's webinar, SALT 2026 Outlook, Trends and Insights for the Year Ahead. During today's discussion, we are going to spend time talking about key SALT trends and issues that are expected to impact our businesses in 2026, potential legislative and controversy matters. Also, we're going to talk about planning strategies to prepare for the compliance season and the opportunities for the years ahead. Now, this is going to be a little bit different look of this. We're going to have slides together, but we're going to spend time talking about what we think are the most critical items that will be hitting us in 2026 on the state tax front. The CPE for this will get 1 hour of CPE, and really excited for this presentation. I'm Mark Arrigo. I'm the National Managing Partner of State and Local Tax here at Cherry Bekaert, and I'm one of the moderators today, and I'm joined by my co-moderator and fellow partner, Lauren Stinson, who is our Sales and Use Tax Leader in our state tax practice. Lauren and I are joined by 5 directors from our SALT practice, and we'll introduce each director as we move through the deck, and we will spend a little time getting to the key issues that we're about ready to deal with here in 2026, which this is going to be a big year for state and local tax. So with that, let's go through the topics. We're going to spend some time on income tax outlook, property tax developments, sales and use tax trends in the digital revenue, tax technology insights, controversy, responding to notices. I think that's something we all just love doing. VDA and amnesty. So we're real excited for this. And right now, I'd like to introduce our first speaker, and that's Peter Beisch. Peter is a director in our state and local tax practice, focuses on income franchise. So without further ado, Peter, let's spend a little time together here and share some insights with the team and all of our participants. What do you, thinking about state and local tax, especially after the OB3, what do you believe is the most significant SALT income tax matter that's going to hit us in 2026, and how is that going to unfold?
Yeah, Mark, that's a great question. And it's nice to be here with everyone today. Appreciate everyone joining in because I know everyone's favorite topic is state and local tax. Um, yeah, so, great question. I think the most important thing that we're going to really dive into this year is around IRC conformity. And the reason for that is obviously everyone is probably familiar with the One Big Beautiful Bill that was passed last year. It's also called OB3, which I think is a funny name for it because it sounds like a Star Wars character. But that bill, that law came with a lot of updates to the tax regime, and I think we're going to see a ton of states react to all the different provisions within the bill. Some of the big things I think that are really states are really taking a deep look at are regarding the 163J provision updates. There was a lot of international tax provision updates. GILTI and FDII landed up becoming NCTI and FDDEI. So we have some new acronyms to learn there. And the big one that honestly we've seen a ton of questions around already is regarding the 174 expenses. And a lot of that has to deal with the fact that, the federal government put back these deductibility of these expenses. And, the states, a lot of them had already decoupled in the past, either through their IRC conformity or through decoupling measures. And as a result, you have these capitalized expenses that are now deductible for federal purposes. And, one of the states I've been dealing a lot with recently is Maryland. And that makes a lot of sense. There's a lot of R&D, from the GovCon industry and things like that. And, the state has decoupled, anything over $5 million of change in income. Maryland has a provision that they can decouple automatically from the bill. So you're going to see a lot of states react to these differences in these provisions. I think 174 is going to be one of the biggest ones we're going to be dealing with, just because it's going to screw up state budgets. There's so many deductions and tax liabilities out there that are going to be impacted by allowing this deduction. And as you can see on this map, about half the states have a rolling conformity statute. The other half have what they call a static or fixed state conformity, which means that every year or every couple of years they will move the conformity date themselves through the enactment process. But the rolling conformity states, if they don't have a decoupling measure right now, technically will abide by the new provision. So I think you're going to see a lot of states react to this. And because it's January, a lot of the legislative sessions have already started or about to start. I think it's an overwhelming majority of them. I think there's a handful that start in the spring, but by and large, they're all pretty much starting up or have started that process. So I think the next couple of months are going to be pretty interesting from a state tax perspective.
No, that's great insight, and I think the key thing is to walk away is going to be you're going to have to look at the what's going on in the legislative sessions, which of course we will follow and share that information as an organization with you moving forward. So, Peter, appreciate that one. Let's switch gears out of conformity, and I think conformity is going to be a huge driver of what happens. But let's go back in time. 1959, Public Law
Right.
86272 hasn't been changed since 1959. What's going on with that, and what should people keep their eye on for the future?
Yeah, no, that's a great question, Mark. And you're right. 1959, that's a long time ago for a law to have been on the books and not been updated. Since that time, obviously, we've become a much more digitally based economy. We're no longer, brick and mortar as much anymore as we used to be. So this has really come to the forefront. There actually was, as part of the One Big Beautiful Bill, there was a provision that was dropped to actually change Public Law 86272, but because of the Byrd Rule and parliamentary process, this wasn't part of the normal budgeting process. They ended up nixing that language from the bill. But really, what it was doing was redefining, in a more taxpayer-friendly situation, what does solicitation mean? Because anyone who's not familiar with 86272, this is a federal law that basically protects taxpayers from being taxed in a multi-state fashion if their only activities are just the mere solicitation of tangible personal property sales. So the redefinition, is to kind of contradict what the MTC put out. So the Multi-State Tax Commission had actually put out guidance a few years ago, which changed their interpretation of what Public Law 86272 was. What they had done was they started targeting things like internet-based activities, which included post-sale chats. They were saying that certain cookies that you would put on people's devices could be considered physical presence. So, and the other one that I thought was, which was odd, was job applications. If they had a portal to accept job applications, that in itself would create nexus. So you see some states already try to adopt this. New Jersey has, California tried to, but they didn't do it in a proper procedure, so it got struck down. But you're going to see states try to pull in any out-of-state income that they can. So that's really what happened for Public Law 86272.
So a couple of thoughts there, Peter, and I totally agree, is I think it's really important for everyone to understand that one cut across the red and the blue. It had almost unanimous support for this to be updated. It was just the Byrd Rule that kind of set that off for the future. So that one, I think we envision this could actually be, a 12 to 24 month, and we could see Public Law 86272 updated very taxpayer friendly. So with that one, I think that's going to be interesting. So I appreciate you sharing the perspective.
Yep.
So let's switch gears a little bit. I think everybody can probably give us examples of, where the states are pursuing aggressively on the income tax policy. Do you want to walk us through some situations on that?
Yeah, so for Public Law 86272, the states are being more aggressive there. And what's going on is that the federal government, this is what we're thinking is going to happen in this space, is that the U.S. government through the Congress is going to change this law where they intended to during the last year's session during OBBB. And I think this year we're going to actually maybe see a law change where they actually enact Public Law 86272 changes, which will impact a litany of businesses. One of the things I think will be really interesting if that happens is in the due diligence process. We see a lot on our end how clients, when we help them on the buy side or the sell side, they're dealing with tax exposures. All right. A lot of times, Public Law 86272 plays a huge role in that. And so I think it'll be a lot of opportunities um, for clients to revisit their Public Law 86272 positions. If they do land up, changing the law and making it more taxpayer friendly, I think you're going to see a lot of opportunities for businesses that are selling inventory to take a look at their activities and see, am I over filing in a bunch of states? So I think you're going to see that kind of opportunity play out.
So let's jump into, we've had quite a few folks. Let's jump into our first polling question. So when was the last time you reviewed state income tax nexus and application of Public Law 86272 for your businesses? Our team regularly consults with tax advisors on this matter. We've reviewed these rules before, but need an update. We've assumed protection under Public Law 86272 and are open to discussing SALT specialists. Public Law 86272 doesn't apply to us as we don't sell tangible personal property. And do recall, Public Law 86272 only applies to the sale of tangible personal property. And also bear in mind, it's a federal law. So that's another piece that the states have to deal with. So we'll leave this open here for a few more seconds as we track through getting that. Peter, while that's open, let's switch gears into the nexus and state trend piece on that. And so, if everybody looks at it, we have a lot of folks here that apparently don't sell tangible personal property because that's about 42%. So that's an interesting outcome, but that also tells you where we are in the digital environment today. So, Peter, let's kind of scoot through this piece based on that last discussion and kind of cover, the aggressiveness on the economic nexus and where the states are going at this point. I mean, is the economic nexus industry agnostic, or are certain industries more impacted by these changes and need to evaluate the state tax footprint frequently? I mean, all this comes into play here.
Yeah, no, it's a great segue from the results of that polling question because from what I saw, I think it was 41% that said that they don't sell TPP. So this is a great segue into this next topic of economic nexus because although I would say it is not industry agnostic, but you will see more industries that are impacted by economic nexus, right? So the ones that really jump out, the industry types are service providers, so professional services or consulting businesses, as well as technology companies that are, doing SaaS or hosting or a litany of other services. Those are the two big industries that, from an economic nexus standpoint, we see the most issues and opportunities with. And a lot of that has to do because of these economic nexus rules. So as we just covered, service-based companies aren't protected by 86272, only sellers of tangible personal property. So if you have a client or if you work for a company that is a service provider, it's really important to think about, am I filing in all the right jurisdictions that I need to be? Because economic nexus is really going to be the main driver for where you're filing. And not to make things more complicated, but the Wayfair case for sales tax was made things a lot more streamlined as far as identifying nexus for sales tax. But it actually kind of complicated things a lot more for income tax. And the reason is because you have, on one hand, you have a sales tax case that defines, $100,000 of receipts is a good barometer. On the second part of that, before Wayfair had actually happened, the Multi-State Tax Commission had established a $500,000 bright line as their recommendation for tax policy amongst the states for income tax. The problem with that is only about 10 or 12 states actually adopted that measure, but every other state pretty much has their own economic nexus rules. They just don't define what that means. So you're left kind of, taking these positions. And now the way I always advise clients is like if you fall between this $100,000 Wayfair threshold and the $500,000 MTC threshold, you're kind of like in this gray area of uncertainty, right? So it's really going to depend on the state and your risk tolerance for, what do I need to do to be compliant? Because on one hand, you might have a state where if you only had $200,000 of receipts, you might say, well, I don't think I have nexus because the Multi-State Tax Commission recommends 500,000. And you might get an auditor that might agree with you. But then there's other states that are super aggressive and would say, if you're $100,000 or over, you have nexus. I've actually run into issues with certain states like Minnesota and Wisconsin are notoriously, aggressive. I've had issues where I'm arguing with the agents where they say, "Oh, if you have $5,000 of receipts, you have nexus," and I'm like, that's from a constitutional standpoint, you don't have substantial nexus. Like it's like they just take the most aggressive position. So it really becomes important to navigate that, especially going back to the transactions we were just talking about. This stuff's going to come up during due diligence. It's important that we tackle it. So if you are in a service-based business and you have not looked at your economic nexus, it's important to look at it. The second part of that, Mark, I think is just thinking about what are the states doing from a tax policy standpoint, right?
Yep.
So the two things that I think are going to be really important this year, and I think you're going to see it more and more, is the two approaches that states are going to implement. So you're going to have your more aggressive states like your New Yorks, your Californias, your New Jerseys. They're going to push hard, I think, on going after high net worth individuals and businesses. It's politically expedient in a lot of those places to do so. And I think other states, you're going to see a more gradual push to being competitive to bring in businesses and people from other states. So you're going to see a much more aggressive approach in a lot of other states that are trying to reduce taxes.
Yeah, I think that's a great point. I think that's what this slide shows that you kind of talk through, Peter.
Right.
So, I mean, I definitely appreciate it. And there's going to be two sides to the story here. So as we let that unfold. So let's move to the next slide. And we got polling question number 2. Which challenges are you most concerned with regarding state income tax? Evaluating state tax rates for my business and investments, identifying tax planning solutions to reduce my overall state tax burden. I have state tax exposures I know I need to start thinking about a remedy for. I am getting overwhelmed with state tax notices. So we'll give you guys an opportunity to come in on that. And I do want to thank Peter for his time and his insights. And we're going to be in just a minute. We're going to be shifting over to Steve Bell is going to be joining us. And Steve is a director. He leads our personal property tax team here at Cherry Bekaert. And I'm going to be excited to get Steve's thoughts. Now it's interesting. Identifying tax planning solutions to reduce my overall state tax burden is about 45%. So it's a significant piece of it. And also evaluating state tax rates for my business and investments is 30%. So it definitely seems like the state burden is starting to take a little bit of front and center. So Steve, let's jump right in on property tax. It's been an interesting one. There seems to be a lot of discussion amongst the states in
Hmm.
2025 to do something around property taxes.
Yeah.
What have you seen or heard?
Yeah. So you're right, Mark, and thank you for the opportunity to join this impactful discussion. But yeah, seeing a lot and hearing a lot, quite frankly. And the states over the last, I would say, over the last several years, have been hearing a large outcry from their constituency, not only about real estate taxes, but also about business type taxes, business personal property taxes as well. But on the real estate side, just a really large issue for a number of different individuals, and we're really talking about mainly on the homestead type taxes. Um, People asking why we're taxed every year. Can't we have a single tax either when we purchase or when we sell the property? Can't we do something to that effect? The tax rates on our personal property, or I'm sorry, on our real estate is just unaffordable. The tax rates are continuing to go up. The values of the property are skyrocketing. In some jurisdictions that have a lot of, I'll call them older Americans, those folks that are over 65, they're just looking at it and saying how unfair this is. We're on a fixed budget and we can't afford these taxes to increase year over year. It's pushing us to the brink and requiring us to take extreme measures. They're also seeing that with young people. Young people look at it and are trying to get into homes, and the value of the homes are exponentially higher. And so then when they get these homes, the property taxes are exceeding their expectations. And then we're also hearing from a number of folks that see that it's unfair when we're using these property taxes to base our school taxes on. There's a number of obviously individuals that don't have school age children, yet they're still paying school taxes based upon their real estate. New York and Texas are two of the biggest ones for something like this. We're also seeing, business personal property tax, as I mentioned, people crying out for reductions there. Um, so it's really all over the board when it comes to that sort of thing. Now, Florida, who I mentioned previously, Florida has implemented a number of significant tax changes. They did increase their homestead exemption, and this could be a big tax break for folks up to about $50,000. They also implemented a rebate program, $1,000 rebate for each homestead, and that was paid out in December of 25. They also looked at from an overall review of appeals. They tried to modify that process as well. They added an enhanced notice requirement and options for the first time electronic hearings. So everything used to have to be in person. Obviously, that creates some burdens for some folks, and so electronic hearings could be a real boon to that. It also clarifies kind of the deadlines for contesting assessments in circuit court, which created some certainty for individuals and for local governments on the timing of these things.
So, Steve, just a follow-up question on that.
Sure.
Which states do you see taking the lead in the effort, and
Yep.
why do you think they're trying to get on the front side of this?
Yeah, absolutely. Yeah, some of those states that we're seeing are Florida, Texas, and quite frankly, New York. And Florida and Texas, I think the issues there are trying to become more friendly for individuals that are retiring to their locations, right? Florida has a huge population of those that are 65 and older, and it could be a real boon if Florida were to eliminate its tax on real estate or have a very high homestead exemption. Same thing with Texas, right? Texas, for years, the burden was on taxpayers for not only the normal real estate, but also real estate related to educational costs. And so they've done a lot to try to eliminate that. New York, this seems to be something that's relatively new under the Hochul administration. They are really taking a hard look at this and trying to determine whether or not, or what they can do for individuals. I think part of this is New York sees a lot of folks fleeing from their locations, and trying to move into locations like a Florida, like a Texas. And it's not only now for the income tax benefits, but also looking for the property tax exemptions.
So is, if the goal is to try to reduce some of the taxes, what's the downside? And, how do you see that impacting, the localities, the schools, the essential service offerings that are required that property tax basically kind of floats the bill for?
It's a huge issue. Obviously, it's how do you make up for that burden? And so you either have to replace the revenue source through some means, or you're going to have to tighten your budgets and reduce some programs. And I think none of these jurisdictions are really going to want to do that. So I think what you're going to find is they're going to be looking for another source of revenue. And there's been some states that have also said, "Hey, you localities, you may have the ability to go ahead and start charging income tax that otherwise did not have the ability to do that." So they're looking at legislation to pass that, to help fill that gap. Because obviously, as we just talked about, right, the real estate taxes take up a huge burden or a huge portion of the revenue, I should say, for these localities. And when you pull that out, there's got to be something that fills it, or else all of the services that are being provided need to be reduced. So I think we're going to find that there's a lot more individual taxes or locality type taxes that are going to come up, or fees. That seems to be a big one where you can say you're not raising taxes, but you're raising fees. I could see something like that happening. Could be a sales tax, maybe another sales tax added on, or some sort of locality tax where there wasn't a locality tax previously. I think something like that could happen.
So what kind of where do you think this is going to go, and what do you ultimately think we're going to see in 2026?
Yeah,
So open up your crystal ball. Let's see
yeah,
what it looks
yeah.
like.
So I definitely think we're going to see something major in Florida, right? There's already legislation that's been put forth. It's going to be on the ballot for 2026. And I could see where Florida passes legislation eliminating real estate taxation for homesteads, or does something dramatic in reductions. I'm going to go out on a limb here and say there's 15 other jurisdictions they're going to push forward major relief, or eliminate real estate taxes. I do think that there's that many states that are out there that are looking at this and trying to figure out how do they become more efficient and more enticing to individuals and businesses. I also think you're going to see maybe 10 jurisdictions that are going to increase the threshold for personal property tax filing. We saw a lot of that, and a lot of it was aimed at the small businesses. But there are a number of jurisdictions that raise that up to well over $1 million. And at $1 million, I'm not sure that you're necessarily hitting all just small businesses. I think there's large businesses that are there as well.
Steve, definitely appreciate the insights again, and the time. So we're going to switch over to the next polling question. How does your company manage its property taxes? It's handled internally within the tax function. It's handled by someone else in finance. It's outsourced to a third party. We don't pay any property taxes. I do think this is going to be a really interesting what happens. And by the way, for those people who are living in Florida, know that in order for Florida to pass that change, it's going to have to go to a vote, and that would require a 60% vote. So that will be interesting to see what happens in some of the key states that property taxes are a significant piece of the revenue base. It also shows you some of the risk when you don't have an income tax on individuals in a state too, in getting there. So here we are. It looks like internally most things are handled there. It's kind of split pretty 37, 26, 24. So, and then outsource the third party 13%. So definitely appreciate the insights on how you're dealing with that. With that, I'm going to turn it over to my fellow partner, Lauren Stinson, and Lauren is going to take us home here. And Lauren, I really appreciate it, and I will let you run from here.
Thanks, Mark. So welcome, everybody. I'm so glad to be here. I have brought my crystal ball with me to help us project and forecast what's going to be happening. We're going to be moving into the sales tax world. With me for our first topic on digital revenue, I've got Chris Hempel. He leads our sales tax compliance practice. He's a director in our group, and really want to dig into what's happening with all the taxation on digital goods and services. As you can see from that first slide, I think 42% of companies are not selling tangible personal property and probably really focusing on digital. So, Chris, what's happening in the digital world?
Yeah, thanks, Lauren. So yeah, over the last 5 to 10 years, we've seen a number of events happen, within the economy and within the sales tax, lawmaking space has really led to the state's ability to become a lot more aggressive on expanding that tax base. We go back to 2018 when Wayfair passed, and it really allowed states to go after remote sellers much more simply and effectively. And then obviously in 2020, we have a global pandemic that shifts a lot of the ways we do business into more of this digital e-commerce space. I mean, we can see that digital advertising revenue over the last 10 years has just skyrocketed. And, as of 2025 has been, somewhere close to 260 billion in overall advertising revenue. And then we're seeing just with our own personal usage, I mean, the terms doom scrolling. I mean, that's a very new topic that's very real that people are getting into, is whether it be attached to social media, buying and selling on Amazon. I mean, my kids just recently got Kindles for Christmas, and they get so excited when they can download a new book. So the landscape has really shifted a lot, and who's really paying attention to this is the states, and they're actively seeking additional ways to grab this type of revenue just because of the dollars and cents behind it. With respects to Wayfair, we're seeing Nexus, with the remote seller economic nexus even become more simplified in states, removing the transaction count. So, historically speaking, the economic nexus has been a combination of annual sales threshold. Most states adopted $100,000, and then some of them had an and statement and 200, transactions a year. A lot of the states, to simplify this, are just dropping the transactions and just focusing on the actual annual, threshold of sales. We've seen 16 states drop the transaction counts just to make it more simplified and just grabbing the revenue piece, typically over $100,000. And then, we're seeing the rapid trend of expanding the sales tax bases. We're seeing a lot of states actively expanding the definition of tangible personal property to include the digital equivalents, ebooks, media downloads, streaming, artwork, and software as a service has been a very big topic. I think, over the last few years, we've seen at least 4 or 5 states and more adding software as a service into this taxable space as well. We're seeing the states go after a wider range of services as well: data processing, digital advertising. So currently the landscape is 32 states tax digital goods and or services, and that's rapidly expanding. What about the next slide here? So key updates surrounding the digital space that we are paying attention to, that we kind of saw happen just throughout 2025 and proposed in 2026. Illinois, and specifically the city of Chicago, has been very, very aggressive in this area as far as grabbing new revenue sources. They, enacted a law, personal property lease tax, which they formed in a way to capture SaaS. That's being taxed at 11% in the beginning of 2025, and it just recently went up to SaaS being taxable, at the rate of 15% starting this year. Louisiana, a state that was not taxing digital goods or SaaS before, just started taxing in 2025 as well. Maine is another one, covering adding tax to streaming services. Again, we're seeing just this trend of states adding new components of the digital space to their tax base to grab this revenue. Maryland and Washington, we're going to get there in a minute on another slide, but they are becoming way more recently aggressive with taxing digital trends. Maryland, this last year, from a sales tax standpoint, started applying sales tax to data processing, SaaS, hosting solutions, and then Washington has always been an aggressively taxing service state, and they had a code in their statute for digital automated services. They also, in October this last year, expanded on that and are now aggressively taxing more digital automated services, including digital advertising, custom software, website development, IT services. Texas is had data processing services. Texas might be, you want to call them like a maverick or pioneer as far as how to figure this out. In 1987, they passed a law known as data processing services. And this was before the advent of the internet. You want to talk about a crystal ball. Texas had a crystal ball on their hands in 1987 when they passed data processing services, which was effectively, the way the law is written, has just been able to encapsulate essentially any future technology usage, because it says basically any computerized data storage, manipulation, archiving, and processing of data. And it's a brilliantly written statute. I know some of us on the taxpayer advocacy side, it's a topic that's very gray. It's always contested, but they wrote in 1987, and any new form of technology, the state has been able to grab inside that statute. So that's something we're always looking out for too. And
I
not
think that
necessarily
really
enacted
brings
yet,
up,
but go ahead.
as I was going to say, I think that really brings up a good point, is that the technology moves so much faster than the states can react. And, technology is just moving at this, such a rapid pace of change that, I think we're going to continue to see a lot of these, states implementing taxes on digital, goods and services.
Yeah,
So
without a
now,
doubt.
in the spirit of time, because I know we've got a lot to cover, just want to really touch on some really kind of new aggressive tax issues that are really focusing on capturing, that attention that is being spent with social media.
Yeah. So what I really wanted to point into here is this is the most aggressive we've seen states. Maryland was the first to do it. Washington just did it. Enacting these taxes on the actual service providers themselves for taxing digital advertising services. This is the idea of actually producing revenue generating ad space, so selling ads on social media. Maryland adopted this in 2021. It's a tiered tax. It's not necessarily a sales tax, but more of a service provider type excise tax, ranging from 2.5% to 10% based on, a tiered rate of global annual revenues. Washington's recent law changes also allow for, again, taxation of digital advertising services, which includes the actual placement and the acquisition of ad space, which is something that we've not seen before. So these two states have been very aggressive doing this, and you're just going to see, in my opinion, more states trying to capture this. We have proposed states. Rhode Island has a 10% tax that's proposed. New York, a 7% tax, and I'm kind of cut off here, but Massachusetts and then at least 11 others have adopted something, proposed legislation to try to get into this digital advertising space. Again, Chicago with an aggressive stance. They were already taxing what they had an amusement tax on in 2015 for streaming services. And now just this last year, they've now started doing this social media amusement tax, which is effectively a kind of a rate, a tax on each consumer that a company collects data from. So if I'm a data collection company, if I have over 100,000 customers in Chicago, they're now going to get taxed at the rate of 50 cents per customer over $100,000. So very, very aggressive movement. And it's something that we're definitely going to want to watch out for this year as states are going to start to copycat the Maryland and Washington as far as being aggressive in the space.
Well, we don't need a crystal ball to tell us that we need to be focused on what's happening in the digital space. So I think we've got another polling question here. Yes, polling question. Is your company in the business of selling digital goods or services such as data processing, SaaS, advertising, and you need guidance concerning sales and use tax compliance? Yes, I need further guidance. Yes, but not at this time. I'm kicking it down the road. No, I would like guidance examining potential use tax exposure, or not at this time. Go ahead and answer. All right. Lots happening. So I'll be interested to see what the audience has here. So you want to release the answers? Not at this time. All right. Looks like we have done a great job, keeping everybody informed with, all the information that we put out as a firm. So glad to hear that, there's a lot of good things happening. So switching gears a little bit, I want to bring in another director in our sales tax group, Chris Grimes, who leads our tax technology solutions. And with all the changes that are happening on the sales tax world, it's really important to focus on tax technology to keep up with that. So, Chris, over to you to talk a little bit about what you're seeing in your crystal ball on tax technology.
Okay, appreciate it. Thank you, Lauren. So really briefly, I do want to mention like what actually is tax technology. So there's a couple of different lenses to view this. One could be from the lens as to is this more of a bolt-on software, such some of the traditional players in this field happen to be like an Avalara or a Vertex and whatnot, and these applications and softwares are basically used to simplify overall sales tax compliance processes. But it also can be more of a built-in technology, so such as like a module with a tax setting that's already built into an application, such as say a Shopify or QuickBooks, pretty much any of the other sales channels and platforms that are out there. So with the understanding as to like what these tax technology solutions are, some of the things that I'm seeing that are kind of creating a little bit of challenges for businesses at this point, they really kind of fall into like three areas. And if you kind of look at them from a high level, you have just what is the appropriate selection of the tax technology solution to use. How do you go about implementing a new tax technology solution? And then how do you go about maintaining that solution? So again, I mean, if you just start off with like the first piece of the puzzle there as to like selecting a new item or selecting a new solution, it really comes down to, again, does it make sense to have a bolt-on solution? Does it make sense to utilize software that you're already subscribed to and have access to? So in order to make those decisions, obviously, then it kind of need to go down the route of costs, capabilities, and things of that nature. So with the capabilities piece of things, makes sense typically to look into things such as state and local tax rates, Nexus dashboards, taxability decisions, certificate storage and filing. Just want to make sure that those items are built in and serve the purposes for the company as to what's needed to maintain sales tax compliance. Second piece of this has to do with the overall implementations. It's an area I typically see challenges on. And this really has to do, again, you can kind of break this down into like a few different areas. And what I've seen with clients, historically and really going forward, like some critical things that typically come up have to do with planning. So where does the actual overall process begin and end? What systems and whatnot are necessary to communicate with each other? You have multiple sales platforms and things of that nature. Um, Timeline, when do you want these things to go live and whatnot? So kind of just getting your arms around and planning these things out are generally pretty critical when it comes to uh, making sure that you can stick to a plan and meet an overall timeline. Another issue that I typically see has to do with configuration and testing. Does the implementer basically have the sales expertise required to complete this overall exercise? Is the knowledge there to determine whether or not sales tax nexus exists in a jurisdiction, what the appropriate taxability decisions are, rates are, things of that nature? And then when you start shifting a little bit away from the actual how-to part of this, then it gets into communication with customers. We do see kind of regularly, um, we work with a lot of companies basically that they start the implementation of the actual software system itself is the very beginning of the company starting to collect sales tax. So does it make sense to communicate to customers and whatnot and notify them of this upcoming change for the business that, hey, we're going to begin collecting sales tax. We need to collect exemption. Do we need to collect exemption certificates? Where are we going to store these things? So communication is generally pretty critical. It'll help solve a lot of rework or back and forth issuances of credit memos and things of that nature. And then once your whole system is up and running, the maintenance piece is like another critical element. There's a lot of thought, or another, not a lot of thought. There's an area that I typically see some form of trip up has to do with whether or not getting a tax technology solution actually automates this overall process of the sales tax function. Is it okay to spend the time and effort getting things up and running? And then is it okay to just let it go? It's Avalara's, Vertex's, whoever's going to take care of this from there. That is, again, a big pitfall for companies. It typically results in um, missing things as the business scales, such as do we need to uh, register to begin reporting sales tax in additional jurisdictions? Does the company start selling a new product and service? Do we need to complete mapping for this? But the maintenance part is generally a pretty critical element that gets missed pretty regularly along the way. And this is all just really just kind of like talking to like the background as to like what are some issues that are typically seen with implementations. Now, kind of taking next steps as to what do we expect to see going forward in 2026. Can you go to the next slide? So the big critical thing I'm thinking that's going to end up happening here is there's a lot of companies out there that still are not using tax technology solutions, and these companies are kind of viewing these solutions as more of a luxury as opposed to a necessity. But when looking forward, uh, just like you and I are starting to use artificial intelligence for some basic things, such as like doing some research, writing letters, like taking notes during meetings and things like that. The expectation is at some point in 2026, and probably is already beginning to occur, you'll have departments of revenue start utilizing these tools as well to assist with scoping audits, audit selection, processing audits, which in turn basically creates risk for companies. So there's a number of different risks that can come up uh, through use of these tools, and there's a number of different areas of risk that can come up through not using tax technology solution, and these have to do with that artificial intelligence piece of increased audit risk, tax-based expansion. I think Chris Semple talked about this a good deal earlier about all the law changes that we've seen. Software as a service has become taxable in a number of different jurisdictions, Maryland, Vermont, Louisiana, quite a few different places. And just general services and digital goods are expanding as well.
Certainly lots happening that we need tax technology to keep up with. So in the spirit of time, let's move to our next poll here. So polling question number 5, is your company organization planning to evaluate or upgrade its sales tax technology solutions in 2026? And if so, would you like to discuss it further with Jerry Becker? Yes, I need a tax technology solution. Yes, I need my tax technology solution evaluated, or no, not at this time. Quickly get through here so we can get to our last speaker, who I will do a quick introduction. Mike Grimm, he is another director in our SALT practice and really focuses on, tax controversy. So let's release the answers to this poll so we can get to Mike. So not at this time. All right. Our last speaker, Mike Grimm, talking about amnesty, controversy, and all those good things. So I know states are being more aggressive. So Mike, why don't you bring us on home here?
Okay. Good afternoon. Yeah, as we've been talking about, if you get the theme of the crystal ball is that states are being more aggressive and more aggressive across multiple types of tax. Tax laws are getting even more complex with the digital issues that have arose, and then they're also using technology to go after taxpayers. So one of the things that I kind of want to finish up with is what do you do if you catch yourself and find that maybe there's a sales tax issue you have, an income franchise tax issue, what that you feel like you want to deal with, to address, and what's the best approach for that, and then just kind of finish with talking about some ideas and thoughts towards controversy in general. So let's start first, I guess, with amnesty. Amnesty, I think, is like the star brother of voluntary disclosures that we'll talk about. Amnesty always gets a lot of publicity. It's usually legislative efforts to raise funds, especially when revenues are down at the state level. They tend to get a lot of fanfare, and then the legislature tends to want to see results in terms of the amnesty. So with amnesties, basically what it does is it's usually for a very limited period. It usually applies to any type of tax that the Department of Revenue, Department of Taxation manages. So issues like property tax may not be part of these amnesties. The benefit for taxpayers, besides providing certainty for them and getting into compliance, is you have a limited look-back period, which varies by state and by amnesty program, and you generally get penalty abatement. You get either some type of reduced or eliminated interest. But be cautious with amnesties because states sometimes they'll give you the carrot, which is the penalty abatement and limited look-back, maybe interest abatement. But if you fail to come forward during amnesty, a lot of times the states will apply more significant penalties under audit for periods that could have been taken care of during amnesty. Now, you don't have to wait for amnesty because most states offer, and it doesn't get as much fanfare and attention from the legislature, they offer voluntary disclosures. So voluntary disclosures operate very similarly to amnesties. The only difference is you don't have to wait for an amnesty holiday. Consider it really as almost a permanent amnesty program. For the states that have or offer voluntary disclosure programs, it's always typically a limited look back, usually 3 to 4 years. They generally either agree to abate penalties, or in some states like California, after you've gone through the amnesty, you can seek abatement. And when we talk to clients about whether it's amnesties or VDAs, what I think always is most important for clients when they're considering these opportunities is certainty. And if you really want certainty for prior oversight, either amnesty and or VDA is definitely the way to go.
All right, and that brings us to our last polling question. Does your company have an undisclosed sales use tax or income franchise tax liability where VDA might be a good option? Yes, no, or I'm just not sure. So Mike, what's your one word of wisdom? Don't ignore it?
Don't ignore it. It won't go away. It only gets worse.
Exactly. All right, everyone's in good shape here. So,
okay. And I'll cover the controversy piece of it. So the one thing that I meant to mention on amnesties and or voluntary disclosures is you cannot have had prior contact by the state. So let's switch gears. Now you can't do an amnesty, you can't do a VDA because you get some type of notice, assessment, nexus questionnaire. Maybe your first time you see this is collections. And what do you do? And so when we talk about controversy, it really encompasses a wide variety of issues. And think about anything that you do outside of just compliance. So when you get a notice, you get an audit, you get an assessment, you have to file a protest or appeal. That's what we're really talking about when we talk in terms of controversy. And really what we're seeing, and we've talked and touched on it throughout the day, is now that states can use technology to look at returns and select returns and issue notices without so much as any human intervention or interaction, we're seeing a ton of states, our clients, getting $500 notices for this or that, where in the past you wouldn't have seen it. Also, there are jeopardy assessments that are sent out that can be substantially large. The other thing we're seeing is an increase in more regional or national information sharing. And so we've seen states get very aggressive in that area. The really most important takeaway with regard to any kind of inquiry from the state is timing. Okay. Typically, when clients reach out to us and say, hey, I've got this notice or I've got this proposed assessment, very first thing we want to do is sort of triage it and figure out where are you in the process and what is it we need to do to protect any of the rights that you have as a taxpayer before you get assessed. Sometimes by the time we get contacted, we're in collections already. So the real key with any type of notification from the state or localities is timing, understanding where you are procedurally in the process. Is it an audit? Is it a proposed assessment that you have to appeal? Or are you in collections? Or did you open the mail and you get a levy? So we're just seeing, as we've talked about throughout the presentation, states using technology and being very aggressive. And we are here to help. So if you do get that notice, the sooner the better that you contact a professional that knows how to work with the states and localities, the better.
Right. So lots going on. Our crystal ball says there's so much happening, so many moving parts, 50 states, they all want their revenue. Just lots going on. So last question, do you want someone from Cherry Bekaert to reach out to you about any of the topics that we discussed today? So happy to help in whatever way we can. All
Hey,
right,
Lauren.
back to you, Mark.
Yep. Thank you, and appreciate everyone's time. And hopefully everybody appreciates the discussion that we put together. This brings us to the end of today's webinar. Thank you for spending time with us. If you indicated in our final polling question that you'd like to continue the conversation, a member of our team will follow up with you. And as always, please don't hesitate to reach out with any questions. We're here to help. Hopefully that comes across loud and clear. Before you head out, we'd appreciate your feedback. Our quick survey will pop up automatically when you exit the session. We'll be sending the session recording and presentation in about a week, so keep an eye out for that. Thanks again for joining us, and we look forward to seeing you in the future, and we truly value your time and interest in our webcast today. So thank you, and I hope you have a wonderful day, and I hope everybody stays warm.
Thank you, everyone.